Come on in, people. Natasha Varela, the Moneyista, tax strategist, business owner, 20 years in audit, accounting, and tax, and 13 in the large business and international division of the Internal Revenue Service. I want to talk about the Tax Cuts and Jobs Act. So you'll often hear me say, the tax code will talk to you, right? It will tell you what it cares about and what it does not care about. And it never cares about your ordinary income. It doesn't care about your W-2. Okay. So the Tax Cuts and Jobs Act, what it did was it increased the benefits for real estate investors, those who purchase property for the purpose of renting. And it decreased the benefits of those who purchase property for the purpose of living in said property. Okay. So the Tax Cuts and Jobs Act increased the standard deduction, which means that now the standard deduction, which just keeps getting higher and higher every year, usually supersedes your itemized deductions, which would be your mortgage interest and your property taxes for my primary resident homeowners. So a lot of you prepare your tax return, you plug in your mortgage interest, you plug in your property taxes and your TurboTax or H&R Block, whatever software, and you go and you get the message, surprise, you're getting the standard deduction, because the standard deduction is overshadowing your itemized deductions, right? That's what it does. That's what the tax code did. It says we don't care. What it did do was say, hey, investors, we're not only going to give you depreciation, which is an expense you don't have to pay, and that removes your tax liability greatly. We're going to give you accelerated depreciation, also called bonus depreciation. So what it did was say, hey, now that this property is an asset placed in service because it's a business activity, right? You're not living there. We're going to give you your regular depreciation, and we're going to give you items in a depreciation, which is an expense for items that are 5 and 15-year useful lives, like your appliances, your appliance wiring, your removable flooring, okay, your driveway, your walks, your fencing. And not only are we going to give you an expense for that, we're not going to draw the expense out over the useful life. We're going to give it to you in year one. You're going to take the whole amount in year one. You get to take the whole amount in the form of bonus depreciation and offset your rental income, right? Now, what this did for investors, because a lot of investors, they are technically real estate professionals via the IRS code, which is material and active participation, which means they spend over 750 hours over keyword in real estate activities, whether it's building, whether it's renting your property, purchasing your property, leasing your property, maintaining your property, any activity associated, the gutters, the hot water heater, electricity, anything your tenants complain about, approving your tenants, collecting rent, paying the bills, sewage, waste, whatever have you. And then you spend over 50% of your time invested in real estate activities, over 50%, right? So what that does is say now the Tax Cuts and Jobs Act says, oh, so now you get all of this additional expense with these items, the flooring, the appliance wiring, and all of this great, accelerated depreciation you get to take in the first year along with your regular depreciation. You get to take that money, which causes a huge loss, a paper loss, right? Not a real loss because you don't pay depreciation, and offset all other income, virtually eliminating or significantly reducing your tax liability. So that's what the tax code says. Tax code says we like business. We like real estate investing. We don't care if you purchase a home to live in. That's what it says. And a lot of you will talk about, well, there's a lot of risks. Your tenants don't pay rent. There is always a preventative measure. If you're here, I'm a proponent of lease protection insurance. All of my tenants have it. I have over $500,000 in coverage for my leases, which means if my tenants default on the rent, once I gain possession of the unit, which is eviction, I will get all of the rent due that was past due and any rent moving forward on the lease. So as long as the unit remains empty, and legal fees. And as far as damages go, that's what your homeowner's insurance is for. And most people who are under my lease protection insurance, they are not reckless. They are not unscrupulous. They know they're on the hook. They know that I don't have to go to court to fight for my money. The insurance company has far more reach. So you're likely to get a very good pool of tenants. I always say my properties are not my assets. My tenants are. Okay. My properties don't pay for themselves. Tenants pay in the form of rent. There's always a preventative measure. Okay. So I hope this was, a little tidbit for you moving forward, because the wealth is in the tax code. That's just what it is. People will tell you invest in real estate, invest in crypto, start your business. And all of these things are because the tax code treats these things better. Okay. Stocks treats these things better than ordinary income. That's why it's always advertise, right? So instead of telling you specifically what to invest in, I'll tell you what the tax code favors. And there is a hierarchy in the tax code, okay? Ordinary income, your W-2 is well at the bottom. At the top right now is real estate and business ownership. So I'm going to drop a link in the description box to the Tax Strategies Mastermind. It is deductible to business owners and real estate investors, of those who are starting your business. It's a startup cost. And real estate investors who plan on investing in real estate. You're getting ready to close, you're in contract, whatever have you, as long as you engage in the activity. Okay. So go ahead and click the subscribe and the notifications bell and continue to follow. Signing out. Bye.